Did you know that there are two sets of tax rules that can come into play with any sort of gift when you have to look at the valuation for gift or estate tax purposes? Well, today's discussion is all about that. Up front, on the initial value, there are certain rules that can affect the value of retained rights and give them a zero value for gift tax purposes. And on the back end, at death, there are certain valuation rules which can tax previously made gifts at their date of death fair market value at up to 100% of that value. Now, both of these rules can apply at different times, but they're very related, and there's a certain interplay between them that you must know. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode, episode 170, our title is Taxonomy, pun intended, of gift tax valuation rules. In particular, we're going to look at code sections 2701 through 2704, at least the 30,000 foot view, and also code sections 2035 through 2038, which I've covered on my previous episodes. So we're going to just kind of look at how these two different sets of rules differ in terms of timing and application, but also work together, especially on the estate tax side. Now, as always, this presentation is not intended to substitute for legal or tax advice. It is provided for educational purposes only. So, if you want a copy of these slides, please also email me at griffin.bridgers@gmail.com. So, when it comes to gifts, if you make a non-cash gift, the standard for the valuation of that and the gift tax is going to be the fair market value of the transferred property at the date when the gift is complete. Now, we're not going to get into the completion of the gift in great detail today. That's its own separate issue that could warrant multiple episodes. But it's also important to note that gifts can have their values changed at the time of death in the estate tax calculation under code sections 2035 through 2038. And for the upfront gift value, even when you have the fair market value, there are certain tax rules which can change that fair market value. In particular, code sections 2701 through 2704 can affect that upfront value of the gift when the gift is completed. So, where does this apply? Well, we have two sets of tax rules here, one that applies for the value of the transfer during life, and one that might apply to the value of the transfer at death when you look at the estate tax valuation. Now, too many retained rights are what we're looking at here. If your retained rights cross a certain threshold, you have an incomplete gift, and you're still going to have assets included in your gross estate, maybe under those rules of 2035 through 2038. But typically with an incomplete gift, while we're not going to go into it in great detail, there would be a situation where the donor has a right to revoke the gift either during life or maybe at death through a testamentary power of appointment. So we've looked at the fact that these rules typically involve retained rights by the donor. But these rules also often involve split interest or fractional interest. This could include a situation where maybe there's a trust that you're gifting into which has separate value components of a present interest and a remainder interest. Could also involve a situation where you just have fractional ownership in something like a business entity or in real estate. You also see these rules come into play when there are certain discounts, because discounts are inherent in those exact split or fractional interest assets I just described. For one, this is a subject I've covered ad nauseum in a number of previous episodes, and it's covered all over the internet if you look at the reasons for making gifts, and it's really to freeze the value of that gift in the estate tax calculation. In other words, what you're doing is you're removing the future appreciation of the fair market value from any future exposure to estate tax. Not only that, for those fractional interests or split interests, the fair market value of the gift itself could be discounted, which also removes that discounted value from potential exposure to estate tax. So in an entity or real estate, this would be a situation where maybe there's an unmarketable or non-controlling fractional interest. And in the case of a split interest trust, This would be a situation where you can divide the fair market value between the present value of a current income interest and the present value of the remainder interest, both based on time value of money. So now we get into our pun of taxonomy, because from these circumstances we can really categorize two sets of valuation rules that can affect the value of the gift. One is the initial valuation rules, and with those things, with retained interest and split interest, Code sections 2701 through 2704 can come into play. And we also have death valuation rules. Now I'm going to kind of break that down into Code section 2035 and 2036 through 2038, just because 2035 is a rule that blanket affects all of those. And I've covered those in previous episodes, as I'll talk about at the bottom. But we're not going to get into the weeds on what those code sections say, but we're going to look at the broad themes that apply to those. Now, previous episodes, I've not necessarily discussed 2701 through 2704, but I have discussed the valuation rules that can create a discount for a split interest between present and remainder value. So go back to my estate planning calculations series, because that's going to help you determine that initial value. And if you go back to the discussions on 2036, 2037, and 2038, along with my discussions on gifts within 3 years of death and life insurance, all those can come into play when you're determining the death value of the gift. So why do we care about the death value of the gift? The gift is made during life. So why this is important is because the gift tax is really a transfer tax that's cumulative and ties into the calculation of the estate tax at death. In other words, the estate tax calculation actually includes all lifetime taxable gifts, because the IRS doesn't want to show an advantage outside of time value of money for making gifts during life versus transfers at death. Now, you get the full applicable credit on the total of assets in two buckets. One is the gross estate, which uses the death value, and the other is the adjusted taxable gifts bucket, which uses the initial value. Now, what those death rules, code sections 2035 through 2038, do is they can shift certain gifted assets from the adjusted taxable gift bucket to the gross estate. And by shifting which buckets those assets are calculated in, you also shift the valuation standard from the initial value to the death value, which means the death value now applies to lifetime taxable gifts. So any prior discounts you took, any annual exclusions that you might have taken, and any appreciation of the initial value will instead now be included in this estate tax calculation. That's a bad outcome. That's going to drive up the amount of your estate tax. So with that being said, one thing you also lose is maybe a discount on the initial value of gifts as well. The initial value is typically going to be the fair market value when the gift is completed, as I mentioned. But in the case of both cash and non-cash gifts, where you have a split interest or entity interest, there's certain discounts that can come into play. These are really valuation plays based on the type of split interest. So for example, if you recapitalize into non-voting common shares versus voting preferred interests and gift away the non-voting common shares, that's a valuation play, but the IRS has certain rules around that you have to obey. Another one would be gifts of remainder interest, maybe in a trust where you have your own retained income or use of the assets. Another one might be a valuation under a buy-sell agreement. If the value in the buy-sell agreement is less than the actual fair market value of the business interest, there may be a gift to the buyer. It could be a part gift, part sale. Same could apply at death, that the buyer is getting a discount. So the question is whether the estate tax applies to the fair market value or the value under the buy-sell agreement. Then finally, Code Section 2704, a little more esoteric. It's a lapse of voting or liquidation rights within a business entity itself. All those are good for future discussions, but I think it's important to note that the central theme here is that there is no gift tax for a gift to yourself, but there could be an indirect gift or estate tax here. In particular, Under code sections 2701 or 2702, those are gift tax only sections where you could be taxed on an indirect gift to yourself. Because what happens is your interest that you retain would be valued at zero there. So you'd be taxed as if you gave away your present interest that you retain. Same thing for gift or estate tax purposes. There could be an indirect tax for a gift to others under code sections 2703 through 2704. Because once again, certain restrictions could be valued at zero or ignored. So for example, under a buy-sell agreement, the discount under the fair market value could be ignored. Like if you have a situation where 50% or more of the owners are family members. Similarly, under code section 2704, lapses of voting rights could be ignored and given a value of zero. And in that case, the entire initial value would be subject to gift tax, both the present interest and the future interest, even though you might be the one retaining the present interest. So what's the interplay here? How do these come together? Well, when we compare the initial value to the death value, we've seen how that factors into the estate tax calculation, but it's important to note that gifts are not double taxed under that type of regime. You either use down the road on your final reconciliation of estate tax, which is the estate tax return, you're either going to use the initial value or the death value when calculating your estate tax. Now, if you've already paid gift tax out of pocket, it's important to note too that there is a credit that you get against your estate taxes for those gift taxes paid out of pocket, where you use the initial value but recalculate the gift tax as if the gift were made at death using today's rates, but the exclusion amount that applied at the initial time of the gift. So the big question here is whether you have any right at death, to retain an interest or control of that property, and maybe whether you give up that type of right by some affirmative act within 3 years of death. Now, that 3-year rule really applies to your own affirmative act of transferring or giving up any sort of retained interest. Now, it might be the case that you have some retained interest for a term, as you might have like with a GRAT, and when that expires, you haven't done anything affirmatively, it's just naturally expired, so you're not going to see the 3-year rule apply there. But if you have to give up a retained right, that's where this type of interplay is going to come into effect. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.